Jeremiah Ong. He's a professional investor with 15 years of experience, specializing in equities, index futures, options, spot forex, and commodities. His experience includes, but is not limited to, being a director in MNC companies. Today, he'll be sharing about the number one mistake retail investors make. Besides that, you will learn about the tools and processes professional investors use and how to uncover opportunities in the new bull run. With that, I'll pass over the time to Mr. Jeremiah to start his sharing.
Thank you, Simin, for the introduction. And thanks everyone for having me today. So by this time, you probably would have heard about the bull run and also how the bear market bottomed out in mid-March through the news, through your friends, or even through experts in the markets, right? Now, if you have missed those early opportunities, I think you don't have to worry, because now the bull run is still very early in the stages right now. And I think in future, they will present a lot more opportunities for you to catch this wave that's coming in. So let me just carry on with this. Okay, this is an important legal disclaimer before we carry on. I hope you take a minute to read it. Okay, so if you have any questions during this seminar, you can just leave it in the chat box, and I will take my time to answer it at the end of the seminar, or if I can't, I will answer it after the seminar and leave it to the moderators. Now, I would like to give you some key takeaways today. And I think the first one that I want to share with everyone here and with friends is that on the number one mistake that retail investors typically make when they invest in the market. So after today, this is the key takeaway. I mean, there are three key takeaways. I heard this is the number one key takeaway that I hope that everyone can take away from this seminar today. The second one will be the tools and processes of the typical tools and processes of what professional investors usually use. Now, there are many tools, many processes, but I think what's important is to understand what are some of the key tools, so you can apply them in your journey, whether you are a new investor, whether you are an experienced investor. And of course, last but not least, I'll share with you how you can uncover opportunities. Because if you look at this bull run, yes, if you look at the stock market, for example, the US market, there are close to 7,000 stocks, right? So how do you uncover which are the ones that you want to focus on? Otherwise, because they are represented by so many sectors in the market. So there are certain ways we can use it to screen and filter, and from there you can uncover some of the opportunities that present themselves. Just a quick rundown of my profile. I'm a professional investor. I invest and trade in equities, index futures, options, the spot forex market, energy market, metals, as well as commodities. And my journey started in 2005. So I experienced the biggest crisis that have affected us in the last 20 years, which is the global financial crisis, which is a decline of 57% in the US market. Now, if you look at what I put here is 2007. So for some of you here who have went through that crisis, you probably remember that it started somewhere in 2008, right? That's what the news said. But later, when I go through the charts and slides, you will see that actually it started in 2007. It started in October 2007. That was when the market topped. And there are a lot of signals during that time already. Right, so later you can see how we can actually use it to uncover and discover this kind of market topping signals. So I have been waiting for this bear market for a while. In fact, because the last bear market that we had was in December 2018. So we had a decline of 20%. So bear market are symbolized by a decline of at least 20% from the top. So that was in December 2018. It was a small bear market, because the average bear market is about 36% decline. So which we saw in this current bear market, right? So the bear market in December 2018 was a mini bear market of sorts. And last but not least, I use various techniques in my investing and trading approach. So I combine price action, fundamental analysis, technical analysis. So a varied approach that I use in my journey. I mean, investors and traders, they may have different ways of doing things. So I will share with you some of my processes. Now, I want to go through also on my focus for equities. So this seminar is more about equities. And my focus is the US market, right? The benchmark is the Standard & Poor's 500, or for short S&P 500. And you, of course, you have other key indexes there, the Nasdaq 100, which is the tech index, and the Dow Jones 30, which is the 30 blue chips of the US market. Now, why the US market in general? If you can look at the constituents in the S&P 500, which is the benchmark, you look at top 10 constituents by index weight, Microsoft, Apple, Amazon, and so on. As I list down, these are global companies, right? These are companies with a global market reach, companies with a monopoly in their sector. They are market leaders. So simply put, if you want a slice of the biggest company in the world, there's only one place to go, this US market. Right? Even China companies go to US, the biggest China companies. And if you look at the sector breakdown, very clearly, the sector is very well diversified across, or rather the index is very well diversified across many sectors like the IT sector, healthcare, and so on. So very well represented, 500 best companies in the stock market is in the S&P 500. So this is why I like to focus on the US market in general. Now, bringing us back home, for some of you may be familiar with the Straits Times Index, which is our local stock market. Now, this stock market is not a stock market I like to focus on. Or simply put, we have 30 companies here. Right? If you can see 30 companies, the banks, which is DBS, OCBC, and UOB, they represent 40.3% of the entire index. So if you look at the whole index, it's very, very weighted towards the financial markets, or rather towards the financial stocks, right? 40.3%, and then the rest, real estate, industrials, consumer, information, IT, telecom. They are not very well diversified. And if you look at all these companies here, they may be big in Singapore, right? However, if you compare them to what you can have in the US market, they are very small. So I give you an example. You just look at the three biggest constituents, right? The banks. So I compare them against what we have in the US market, right? So UOB, DBS, OCBC, JP Morgan, Bank of America, Citibank, these are US market. If you look at the market capitalization for UOB, it's 34.8 billion Singapore dollars. DBS, the largest one, 54.76. And then OCBC, or rather OCBC is the second largest, 40.52. Now, you look at JP Morgan, market cap alone in Sing dollars is 394 billion. It's the largest market cap in this market, and it's way bigger than even our biggest player, DBS. Bank of America, same, 281 billion Singapore dollars. And Citigroup, the smallest player, is also 146 billion. So very clearly, if you want to have a slice of the global market, so you have to look at the US market. So this is why we always want to look at where we can find growth. Now, this is just companies, but how does what's important? Some customers, or rather some clients of mine last time, or even some friends of mine, they also ask, what about exchange rate, right? How does the exchange rate matter in this? Now, if you look at this is a monthly chart. So dollar Sing, we call it dollar Sing, which is the US dollar against the Sing dollar. And if you look at how the trend is like, so very long term, this monthly chart, each bar here represents 1 month. So if you can draw a line, a trend line, you can call it, right? It's upward sloping, right? So for example, let's draw a trend line. Trend line's not working. Okay, never mind. Okay, so you can follow my arrow here. You can see the line, the trend is upward sloping. So the US dollar here being the base currency, right? So one US dollar can buy 1.394 Sing dollars. This is a few days ago. So meaning that the trend, even for the long-term trend for the US dollar, is upward sloping, right? So in fact, we after the downtrend we saw sometime before 2010, you can see here, marked by 2009, 2010. Afterwards, it's just upward sloping, right? You have higher highs, higher lows. So very clearly, even if you were to talk about exchange rate, I think you have the US dollar is rising against the Sing dollar, and of course, the exchange rate is not a key factor for my consideration of which market to go. Because if you look at it in 09 against now, see 09 we're somewhere at 1.472, right? Right now it's 1.46. It's really no difference, because at the end of the day, in the long run, exchange rate always equalize. So what you want to consider is consider companies, consider the sector where you're investing in rather than exchange rate. So if I go into the returns, if you look at the S&P 500, which is marked by these are the bar chart here, right? Or the candles. And then against STI, so you can see STI is by the black color line. So clearly the STI has returned about 56% over the last years. 09 to now is 11 years, right? Compared to what the S&P returned, 292%. And so quite clearly, if you want to talk about investing in equities, you have to look at the US market. That is the benchmark for the world. So just to move into some technical details. When was actually the bottom? Right, I give you a snapshot of one of my accounts. So the bottom was already actually in 20th of March this year. Right, I give you a snapshot of my performance profile from 1st April to when I first prepared this slide was 25th June. So you can see at the profile here is 140% since 1st April. Now I want to show this profile here, not to show you a very smart one. I want to show you that whatever I say, I put my money where my mouth is, right? I actually do it. So not just when I look back and then I say, oh, this is where the bottom is. I actually do it. So to show you that I mean what I say. And this signal is what I have been waiting for, like I say, for a long time. And so they finally showed in late March and early April. I got it because I knew this is the signal I'm waiting for. I saw the signal coming in. When everyone was bailing out of the market, I see this is the time I want to go in. And of course, if you have that, if you have in investing, you need a bit of luck. Of course, you need to have a process. You need to have you need to be brave as well, right? So if you have luck, you have process, but you don't dare, you can't benefit from the market. This is how it's like. So I loaded quite a bit, but you must always maintain spare ammunition, because no one can predict the market. No one will actually know, right? What if the market goes make a second bottom, right? So always be ready to average down if necessary. So give you a snapshot of the S&P 500 as of now. Now this is probably done 2 weeks ago. So the S&P 500, as you can see, I just showed two boxes here, the left box and the right box. Now the left box here is actually the previous bear market I talked about in December 18. And this is the one that we had, right, from February to March this year, just a 1 month. 1 month bear market. You can see very quickly, in 1 month, the S&P took out the gains for more than 1 year, right? This was December 18. It went up to February 20 here, right? In 1 month, it took out everything that was gained in almost 1 year, 2 months, right? It was very, very quick, very swift. That's why a lot of people were so scared, right? Because they've never seen something like this before. So this was 20th of March. That was the bottom was made. Now this is a weekly, we call it a weekly chart. So each candle here or bar, you call it represents 1 week. So by the time of 23rd March, the S&P 500 has fallen 36% from here, all-time high. So this is one signal, right? 36%. Remember I was selling just now. The average bear market is about 36%, right? Since all-time high from way of 17 Fed. So this is way of 17 Fed. So bear market is when the index fall by more than 20%. And as of June, the SPX actually risen by 41%. So this was sometime 25th June. From here to here is about 41%. And as of then, June, it was about just 6% away from the all-time high. As of today, it's risen really. So I just present here. This risen a little bit, but at least you know where the index stands right now. So once the index is less than 20% from the all-time high, from the previous high, it's no longer in the bear market. So we are no longer in the bear market really. Even though you can read all the bad news, but we are no longer there. We are really out of the bear market sometime ago. So same for Nasdaq. I like the Nasdaq because Nasdaq is the leading index, right, for tech companies. And if you look at the S&P, just now I was showing you, many of the constituents are tech companies, right? So tech companies are important growth sector. If you are investing, for the long term, they are going to lead growth, and Nasdaq has indeed led growth for many years. So it comprises many of the companies. Primarily, you can recognize this: APL, Apple, Microsoft, MSFT, Amazon, AMZN, Google, GOOGL, Facebook, FB. So among many other tech companies, these are the primary ones you can find in NASDAQ. And by the week of 23rd March, the NASDAQ has fallen 31%, just a little bit below SPX, or rather a little bit higher than SPX, so it didn't fall so much. And so again, it's no longer in the bear market already. So because it has risen 49%. So you can see here, this 25th of June, right? It broke the new high. As of today, we have already broken another new high. So let me just give you a highlight of where we are today in the NASDAQ. So, okay, so you can see here, the weekly charts. Okay, maybe it's easier to show you the daily charts. So this is a NASDAQ index. Daily charts meaning that one candle here represents 1 day. So this was where the top was. The high, this was the COVID high, right? This one, right? They broke this high here. So broke this high was broken sometime in May. Okay. End of May, right? End of May broke the high, took out this high. So after that, when I prepared the slides, was somewhere here, right? So they took out previous high. And as of this week, or rather yesterday, they again went up to a new high. So NASDAQ has been making new highs. And not just that, you can see lows, right? Higher high, higher low. You can draw it. My marker is not working, so I have to use the arrow here. So you can see higher high, higher lows. Now, why I want to present this is important because later you understand what I mean by having this high lows important. So before that, I just want to show you something. Now, we know that it has been crazy, right? Because we see crazy news, bad news. So question we need to ask, are we really out of the bear market, right? So what did some of the economic news on newspaper you say? Right, this was done in 26th of March. I just wanted to take note of this date here. Now, 26th of March, US jobless claims, which is the unemployment claim, saw past 3 million, the record high. This number shatters the Great Recession peak of 665,000 in 2009 and blah, 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 right? So remember the week of March 23rd, that was the bottom. That was the bottom. So if you read news like this, you will definitely think that this is crazy. This is going to be the worst ever recession, the worst ever crash of all time. You would never buy it. You would never buy the stock market because you look at this. Look at the way they say the number shatters the Great Recession peak of 600. So, but you got to ask yourself, what does the number present, right? So at the same time, I'll just give you a brief snapshot of this. The S&P 500 dividend yield. So companies in S&P 500 also give dividends to their investors. And at the same time, so the dividend yield here is marked by this line here, and then the treasury yield, the blue. Now, treasury yield is like bonds; they're safe assets, so they're fixed income assets. So people buy bonds when they are scared, right? So when the bond yield, when do bond yield fall? Now, bond yield and bond price has an inverse relationship, right? So when people buy more bonds, right, you can see the yield actually fall, right? It fall. In fact, it fell to record low. So the thing is that at this point here, you can see the gap between the yield and the two yield, dividend yield and the bond yield is at a historic high. So which means people want a lot more premium, right, before they're willing to buy into stocks. So these are numbers that we see here. Now later you will see that when you see record unemployment claims, when you see dividend yield, this gap between the both the bond yield and dividend yield side, these are actually signals that we are reaching a bottom, right? These are signals. Of course, there are a lot more other confluence factors to look at. These are signals. So if you can avoid all this news, right? Look at processes, look at the numbers, actually tell them we are at the bottom. I'll show you a lot more later. Right. So how about other indicators that are covered? So I also look at this, like for example, this is the CBOE, right? Volatility index. Now, for short, this is the fear index, right? The if you look at the numbers here, I'll highlight them later. Put call ratio, the bull bears. Okay. So okay, look at the fear index first. You can see here the fear index where I highlighted here. Now, this was during the financial crisis, 2007, 2009, right? And this was this year. So you see, whenever the fear reaches all-time high, it's also where markets reach the bottom, isn't it? So when people are very scared, right, market bottoms. So this is another signal, right, to you. Hey, we are 80, we're in the region of 80 again. Isn't it something to think of? It's more than 80, in fact, right? So just want to know that, hey, so another thing is the put call ratio. Now, the put call is so let's just give a very brief update. Like put options, you buy put options is when you expect the market to fall, right? You buy call options, you expect market to rise. So when they use this line here, 1.15 as a benchmark. So whenever the line rises above 1.15, it shows that which means more people are buying put options, right? A lot more, like great number of people buying put options. So it shows that market is bottoming as well. But this was the this is the current one, right? So the current bear market. So once it reaches above 1.15, market reaches the bottom. And this is an interesting one, the bulls bear ratio. Now, this is current, right? But if you look at so let me just give you a line here. You look at the red line. Red line is the bullish sentiment. The green line here is the bearish sentiment. Now, if you look at this, is the previous bear market in December 18. When they cross, when the bullish sentiment drop very, very low, the bearish sentiment go very, very high. So when bearish sentiment goes towards 40, the green line, it intersects with the red line, it shows the bottom. Right? The same thing happened here again in 2020. The bullish sentiment went very, very low, the bearish sentiment very, very high during that time, market bottom. So there are many, many indicators that use compared, like you saw just on unemployment, then you see they all come together, right? When you see things coming together, it gives you a lot of confidence that maybe we are really at the bottom. Right, so these are the key things. And there are, of course, other things that we look at. But now you know, right? You start to put things together, you can see why I think that was the bottom. Okay, so this is what I'm referring to. Now, I go back to 07. No, this was the crisis, 07, 09. Now, when you know there's a downtrend, now you look at the boxes I highlighted. You can see here, right? High, this is a high, this is a high. You start making higher highs. Sorry. Start making lower highs, right? Lower highs. Right, then lower lows, right? Lower lows. So you know that it's going down, it's a downtrend. It happened before. Lehman Brothers was what, September, right? September, it was somewhere here already. So market already showed that kind of trend way before that, right? And then where was the bottom, right? It made a bottom, and it stopped making another lower bottom. So it went higher low, right? High. This one was unsure, right? So the interesting thing, this was the previous high, and then the low, and then when the market start making this high here, and people are unsure, so are we going to make a higher? Because it's important here. Now higher high here doesn't mean that it's going to be a higher low, right? We wouldn't know, right? We wouldn't know. So when markets start to make a higher low, it rejects the low, it rejected the sellers, and it made a higher low. We know that we have confidence it's going to go higher, right? Higher low, higher high, higher low, higher high, and then the rest is history. As you know, the market went all the way up. So these are some of the factors that we also take into account. So higher low and higher high is important because that shows we are in the start of a new trend, a new uptrend. Right. So all the lower highs, as you can see the arrows here. So these are key things that you take note. Higher highs, higher lows for a new uptrend. So Nasdaq that I was showing just now, it broke the higher high already. Now the key question now for Nasdaq is where is the low, right? We wouldn't know. I wouldn't know as well. So, but my belief is, we're not gonna go back to the COVID. We're like based on the market trends, based on the way the price has been making their patterns, and I really expect we're going to make a higher low, and then we're going to continue. The market will never go in a straight line. You can see, right? It will never go in a straight line. It doesn't happen. So we make it. First, it's important we break a new high, right? Next, it's important that we make a new low, a new higher low, and then we go up. And we see this in the other constituents in Nasdaq as well. For example, in Apple, same, broke the pre-COVID high. This was a COVID high, broke the high, made a higher high. Amazon as well, right? Broke the pre-COVID high. In fact, Amazon is higher than what I showed here already, right? Because it made a new high yesterday. Sorry, the day before yesterday. So quite clearly now. Okay. So I want to highlight this. Now this was the previous bull market, right? You can see here, March 09, all the way up to this year, right? Somewhere here, sorry, or rather here, right? So March '09, so the Nasdaq, because Nasdaq just broke new high, so I want to go back to where it happened 10 years ago. So back then, it took almost 2 years, right, to recover the high from March '09 until February 11 was 2 years, right, to recover the high they made in '07. And now for people who are scared, say, hey, Nasdaq made a new high. No, I think the market is going to go back down all the way down. I'm going to sell now. For those people who actually do that, right, they miss out on the rest of the gains because the Nasdaq made 856% gain from March '09 all the way until February 20 before we had a bear market. So if they sold now, they will have lost the rest of the 730% that Nasdaq went up. So it's important to stay invested in the stock market for the long run, because this is where the massive gains are made. Especially right now, when we start the new bull market, you want to stay invested inside because you want to ride this massive wave from this where this new bull market has taken off. Okay, so key question now, right, is the current price point I buy. Now I go back to Nasdaq. This was again in June. So now this question you need to ask is, you need to use the perspective to buy or not to buy. It really depends on your strategy, because some investors like to buy breakouts. Breakout means they, after this high was broken, or they find a new high, they hope to chase the breakout, right? So because they think after new high is broken, they can chase it. There are many different strategies to investment as well. So, but another way is to use moving averages. Okay, now I just give an example here. The dotted line here you can see is the 20 period moving average. I'll talk about it in detail. This is the 50 period moving average, and this is 200. So you can say that you can just, for simple reference, the red dotted line is a short term, the blue one is a medium term, the red one is a long term. You can see the Nasdaq is in the long term uptrend, right? Because all the moving averages are above each other, and you can see the 200 is simple, is in the long term uptrend. So I prefer to buy based on moving average, and I like to buy on the dips on the uptrend. So this is the uptrend. So where are the dips? For example, I just give you a quick chart. You can see here, when they make higher lows, right? These are all dips here. These are the dips. These are the dips. So this was the crash. So you know it's near the, honestly speaking, it's near the 200 already. You know, there are certain ways of seeing the bottom. So these are the dips as well. These are the dips. So whenever you have a dip on the uptrend, these present opportunities. So currently, we are quite far away from even the short-term moving average, right? Quite extended. So my strategy, I don't like to buy on breakouts, right? Because it's just not my style, right? I like to buy on dips. I like for it to retrace back, right, to at least the moving average here, right, the 20 or the 50, right? To reach 200, you need to have another crisis, right? Because it hardly reach. Whenever you see when does it reach 200, is when we ever have the bear market, right? So whenever the bear market reaches 200, you know there's a good punch, right? But if you're talking about a healthy retracement, it's about 20 or 50. So I prefer to buy on dips. I don't like buy on breakouts. So it's a bit extended for me right now. And I prefer for Nasdaq to come back down. You always come back down. You just follow the trend of the last 10 years. They will come back down. Some bad news, some don't know, trade war, whatever you give it. I mean, market gives itself reasons all the time. So we don't care about the reasons, but it will come back down. So that one you need a bit of patience. So of course, this is assuming that the company you're investing in has strong fundamentals, because we only want to buy industry leaders. We don't want to buy the weaklings, right? Because this only works if you're buying industry leaders. So avoid value traps. So what I mean by value traps here? Okay, before I go into the value trap, I give you an example of buying on dips. Right? I just showed you healthy uptrend, higher highs, higher lows. So you buy on the higher lows, right? When you retrace to the moving averages, right? Use moving average as a reference. 20 period simple moving average, or you call it 20 SMA for short term, 50 SMA medium term, 200 SMA long term. Now we want to make sure that the 200 SMA is in the long term uptrend. This is important, right? This is the first basis. They must be in a long term uptrend because you're investing for the long term. You're not trading. So you must make sure the 200 SMA is sloping up, like what I saw just now. That's that. It must slope up and it must be in a long term uptrend. So that's the most important thing. Then you can time your retracement, or you can time your buying when it reaches here or here. Now, so which one, 20 or 50? I wouldn't know. Nobody would know, right? So if you are not sure, we always buy in batches, right? Whenever it reaches a 20, you buy a bit. When it reaches a 50, you buy a bit more, right? So this will make sure that you can participate in the uptrend without missing out. Because sometimes it reaches 20, it doesn't come back up. Because what I'm using here just now, let me just go back. a bit here. All right, so this is a weekly chart, right? So weekly chart means that each candle or each bar is a week. So this is a pretty long-term chart, right? It's not a daily chart. So you can see Nasdaq, it doesn't really come down to the 50 when it's a healthy uptrend, right? For this is what, 2016, 17, 18. You can be waiting 3 years and it doesn't come back. So on long-term charts, right, they tend to stay above the 20 if it's a healthy uptrend, right? When it reaches 50, because there was some major news, so when it reaches 50, it's good time to buy as well. So if you want to make sure you participate in the uptrend, you can look at the weekly. Daily is different. Investing, look at weekly, right? So just make sure that you reaches 20, then you just buy a bit, buy a bit, buy a bit, buy a bit. You cannot go wrong here because you buy on moving averages. So you see, if you buy on here, you're so far away from moving average, it comes down, right? It comes down. Okay. So this is some examples we can refer to. I mentioned 200. 200 is when you can see the crisis, right? So they almost never reach 200 because Nasdaq is a very strong trend leader. Now, I'll give you an example here for some value traps I'll discuss a little bit. Right, 2050, 200. Now, a healthy uptrend is when the three moving averages are above each other, right? The short term above the medium term above the long term, right? And they are in line. So, okay, the NDX live chart walkthrough. I went through it just now, so I won't be going through that again. So now what's value trap? Let me give you an example. Now, I have some friends as well who ask me, hey, the oil and gas sector, can I invest in it? Right. So let me give you an example here. Now, this is a very long-term chart. You look at it monthly, the oil and gas sector, all the way back to 2000, before 2008, right? So you can see through almost 12 years here. Now, you look at the oil and gas sector, what trend are we in right now? So basically you can see 200 stopping up. But when price is below the 200, I'm not confident of this strong trend because you saw Nasdaq just now. When the trend is good, healthy uptrend, the price is always above the 200 because the 200 must be like the boundary, right, to prevent the price from going down. So I'm not sure. If you look at the way the price pattern making, right, it's like in a range. It's like in a mega range, right? This is the resistance and this is support. So I don't know where is oil and gas going to. It seems very cyclical, going up, coming down. The last 10 years, it's not been making headway, right? It's stuck in this range here. So I don't like the oil and gas sector. I mean, for investment, I don't like, because I don't like the way the trend is, right? Look at this trend compared to Nasdaq, right? I rather buy the tech. So, but if you're talking about trading, yes, there's some opportunities here, right? I mean, I won't be going through the trading ideas on how to, because it's a bit complex. But yes, trading, yes, you can buy it for trading if you have a certain trading parameters. It does give you a short-term play, but for investing, I probably don't think so for oil and gas sector, for the oil and gas industry, right? So airlines, right? Because airlines was also quite popular. People asking airlines. Now airlines, are they in a long-term trend? Yeah, I think the prices are really in that long-term trend now with 200 SMA here. This is where the price are here. So I think that airlines, not every airline, which you can see later, some airlines may be okay, right? Some may be okay, not all, right? Some may be okay, some not. So you have to be selective here. I don't invest in airlines because I don't like the business model. Very low margins, very competitive, very high capital expenditure. I don't like the airline sector. I don't like the airline industry. But if you want to invest in airlines, you could be selective here. So let me give you an example of what I mean by here. I go to the charts. Maybe using two airlines here, right? American Airlines. Wait for a while. Okay, so this is let me use a monthly chart to make it even easier to see. Very long-term chart. Now, if this is the, on the left side, you can see American Airlines, right? On the right, you can see UA. So to know which one the industry leader, right? Basically the stock itself must represent a bit like the industry, like the sector or the industry chart. So if you can remember just now clearly, which one looks like the industry chart? Like United Airlines, isn't it? Right. So you can see here, this is still sloping up, right? This is the 50. The thin red line is a 20. Right, I can add a 200. Let me just add it in. Right, 200. SME 4. Okay, it's not loading here anyway, but doesn't matter. So the 200 is, if you remember that's how the chart here, right? See, this is 200. So the United Airlines chart look more like the airline industry. So you probably know that United Airlines probably is a better representative of the industry. Let's compare the UA, let's compare the AL, right? See American Airlines, lower highs, lower lows, lower highs, lower lows, lower high, lower low. And then you see the price is resisted by the 20, right? So I'm not sure. I wouldn't do, if you really buy Airlines, I wouldn't buy American Airlines because the chart doesn't look good. See, it doesn't have the strength, right? So if you buy airlines, I prefer UAL. Now, that's a disclaimer. I'm not going into detail on the airlines and their fundamentals because I said I don't like buy airlines. But just by looking at chart patterns, you probably know that UAL gives a much better representation of the airline industry, which you saw here. Right, this is the industry chart. Now, of course, in this airline, in this industrial sector where they're in, is there something else better? I think there is, right? So aerospace and defense. If you look at aerospace and defense, which is in the same sector as the airlines, right? Quite clearly, you can see it's much stronger. They do have to be founded by the 200. They are near the 50. In fact, it's rejected a little bit, but it's near the 50. So now remember, every strong, every healthy uptrend must be above the 50. Right? If the price cannot stay above 50, then the trend is not strong, it's not healthy. You probably don't get on it, right? So this is a very long-term chart. So the price must stay above 50 for a trend to continue in the long term. So since they're so much nearer here, they're stronger. They're much better state than the previous airlines industry. And for example, Lockheed Martin, right, one of the leaders in this industry, the aerospace and defense industry, it's much healthier than airlines this year, right? The 50, right, acts as a support for this stock here. So I think there are better plays out there than airlines, and I think that these are some of the ideas. If you go to the sector, you should always look at the industry themselves, see how the price are doing. Are they healthy? Are they good? Are they above the 200? Are they above the 50? So you want to look at industry leaders in the sector as well. So for example, you choose one sector, industry sector. So you want to find, okay, this sector, where are strong players, right? Go into the industry, see which charts are healthier, which points to a healthy long-term uptrend. This is where you can focus on. So, okay, so this is the key takeaway that I wanted to give everyone today, which is how do you avoid the number one mistake retail investors make, right? How to avoid buying at the top or selling at the bottom. But the first thing you do, right? The first thing, this is something that I have made as well in the past. So whatever mistake I made, I share with you. Do not read the news, right? Never make your decision by reading the news, right? So don't buy the euphoria, don't sell the doom and gloom. Don't read the news and make the mistakes. So for example, I give you an example here. April 14, this is give you some of the slides here first. So the first one on the left, April 14. This is an IMF blog, right? The Great Lockdown, worst economic downturn since the Great Depression. You can read it while the world has changed dramatically. The magnitude and speed of collapse that followed, unlike anything experienced in our lifetime, right? ABC News, 8th of May. US unemployment skyrockets to 14.7%, the worst since the Great Depression, right? This one, New York Times, 6th of May. EU is facing its worst recession ever. Watch out, world, right? You look at this news here. I mean, just to be honest with you, everyone reading this news and making investment decisions will do only one thing: sell, right? Sell. Because see, the news, they are not here to help you to make investment decisions. They are here to sell their news. They're here to get editorials, to sell their papers. So they had to make it sensational. And when you read sensational news, right, you also make sensational decisions, right? So you cannot read the news and make investment decisions. You must need a logical mind, you need a logical framework, you need processes, you need to have objectivity in your decision. So by reading the news and making investment decisions, the worst thing that you can ever do. Right? So remember, never read news to make decisions, right? Even more examples here, because this was the previous recession, right? 09, the GFC. The worst recession in over 100 years. The worst year for jobs since 1945, January 09. Remember, when was the bottom? March 09. when you read this news here, you're selling near the bottom. If you're holding on to stocks, you're selling near the bottom. If you're not holding on, you want to short the market, you are selling near the bottom. So crazy things to do, right? If you read the news to make investment decision, you lose a lot of money. And then, yeah, so the doom and gloom is over, right? So this is the euphoria, right? So what happened here? October 9, 07. I told you the top was in October, you see. So Dow and S&P break records. Wow, blue chip hit intraday high. S&P 500, February, right? This was just before the crash. Nasdaq hit record high. Wonderful news, right? So this one is in February 20, right? Again, just before. Dow and Nasdaq approaching big milestones. It's too late to invest. Right? See, when you read news, you read euphoric news. Like, what do? You invest, you buy the top, right? So this is why people always sell the bottom and buy the top, because they read news to invest. So never, right? So Bloomberg, same thing as well, right? You whatever news you okay. I honestly this news column here I think I cherry pick on it because I really didn't read all this news then. So but in order to show you, I had to go and find, right? So I did my research and I find out this news for you. So you can see here during February, stock enthusiasm is snowballing, right? And then give you reasons, coronavirus may not end the bull market. And then they say bond rally is a good sign that investors are not complacent. They give you reasons why the stock market is enthusiastic. But honestly speaking, nobody knows the reason. Nobody can predict the market. We only can look at the price, and then we can only look at the company fundamentals, and we make a decision, right? So no one can predict the market. So besides news, right? So let me just give you some highlight here why I want to show this column here. Now, other than news, you have experts, right? Now, I'm not saying that the experts don't know anything, but nobody can predict the market. So this was the September 2018. You can see later it was also the market top before during the last bear market in 2018. Right, what trade war? Dow hit record high. Right, so Mohamed El Arian is a very established expert here. He's a chief economic advisor of Allianz, and previously he was also the CIO, co-CIO of PIMCO, which is one of the largest funds in the world. Right, so when you read experts like this, right, you tend to make decisions because experts say this. Should I just follow the expert? So, I mean, he has really his CV is really very accomplished. So, now I just want to remember, right, September 20, when he said investors recognize fears are short term, but this is where we also had a market top, right? So reading experts also can make you go into wrong decisions. Right, I'll give you another example, right? Bank of Singapore, which is the private bank of OCBC, back home. CEO is also very accomplished, 30 years in the private banking. He was also in UBS, and he's also in the Council of Presidential Advisors in Singapore as well. Right. So what he's saying in March this year, right? This is March 25th, right? Remember the bottom was March 23rd week. So use the rebound to sell because we are only seeing the first part of the crisis. Countries are not prepared. I mean, just imagine, right? You're a customer of Bank of Singapore. So I'm just giving examples here. Now, don't read experts, never. So give you a quick example as well. Now, this red color box here highlights the uptrend that we saw from this market recovery. Yeah, this year. So this was sometime in May, and this was 11th of June. Right. So this 8th of June. This was 11th of June. So you see, market went up very quickly. Right, it recovered very quickly on the first week of June, and then it drops. So what happened during this period of time? So New York Times reported we strike recession, stock market stay positive for the year. So this was 8th of June, something like 8th of June, right? It reached back the high we made in 2019. Right, 8th of June. So on the 5th of June, because the stock market was recovering, right? So they say the stock market doesn't care. Right, all these problems here, no problem. And just a few days later, and the news tell you investors are no longer in denial, right? 11th of June. So what I'm trying to say is, if you read the news to invest, you go crazy. Because one day they see this, next day they say that. So you go crazy. So just remember, anything you during this webinar, the first thing and the one thing I really hope everyone takes away is do not read the news. Just use them as entertainment device, right? Never make decisions from the news. In fact, even the president of USA, Donald Trump, knows this, right? Right, he's a show host, entertainer, but he knows something about it, right? He knows something about it. Because now, media is always being used to influence markets, and he knows it. So when the so-called rich guys speak negatively, you must always remember some are betting big against it and they make a lot of money. If it goes down and they go positive, get big publicity and make it go up, right? They get you both ways. So they know it, right? So Denzel Washington, the Oscar-winning actor, also knows it. This is just some snippets I pick up. If you don't read newspaper, you're uninformed. You read it, you're misinformed. So I'm not saying you shouldn't read the news. You read, like I said, you read the news for entertainment, right? And you don't use the news to make your decisions. This is very, very important. Just remember, this is one thing you must take away. So I'll give you an example. Now, if you had not read the news, remember I said the S&P fell 36%. So if you average out all the bear markets over so many years, negative 37%. So bear market fell 36%, average 37%. Hey, then you ask, hey, let's say you even have no processes, right? You say, hey, we're quite near the average, isn't it? We're quite near the average. So if you sell at the bottom, right? So it gives us some ideas. Now, if you saw unemployment rate, so why don't we read something more objective? So, for example, Great Financial Crisis. This was the time. This line here represents the S&P 500, right? The blue line here represents unemployment rate, right? So we can see Great Financial Crisis, market top here. What is the unemployment rate? Very low, right? Very, very low. So whenever market top, unemployment also hit the rate is very low. Market toppings, whenever market tops are, the country is enjoying high employment, and they always full employment, very low employment. So it happens as well this year. COVID-19, we had a market topping here. And what happened? Unemployment was at an all-time low. Look at that. Even lower than the year 2000, right? Unemployment was very low. So market was very euphoric. Yes, we had the best time in the economy. And what happened? Market crashed. And then unemployment rate went all the way up to, you saw just now, almost 15%, right? And that's where, so whenever unemployment and the markets, right, have this great difference, right, this record high, record low, you know that we are at the market topping and market bottoming situation, right? So when you see things like that, unemployment rate, you shouldn't just say, yeah, you read the news and say that this is going to be worse. You should have the right processes. So compare it. What does unemployment tells you with reference to what the stock market tells you? Then you will go and dig out all this information, these charts here, and you start to compare. So use processes, use the right tools to help you make decisions and not the newspapers. Right, so this is from Morningstar. I just give you an example. Now, the stock market is not the economy. You can go and find out this article here. It's available online. Right? So remember that the stock market is not the economy. Right? Do not read economic news to make stock market decisions. Right? So the earlier you understand this, right, the less you will read news to make decisions. In fact, you will not even read news at all. Right? Same thing. New York Times finally give me something that's sensible now. Right? Markets are not the economy. Right? So, for example, economists will study show that there's little evidence that economic growth matters to outcome market at all. The linkage is pretty weak. In the long run, the relationship is empirically not there. Right? So it's not by me. At least from the Times, they say something that makes sense here. So I never studied it, right? It's not important to me. I just read what is the price now, right? But at least you know the market is not the economy. So don't treat them as such. So what did I do, right, back in February when you do read news? So very simple, right? So I give you an example here. Now this is ES. What's the ES? The ES is the S&P 500 futures, right? Because I also trade stock options as well. So give you an example here. Now the futures here, right? So index futures of the S&P 500. So I actually opened up a bear put spread. Bear put spread simply means I'm bearish on the market because the market showed me a double top formation really, right? So I go and place a bear put spread, right? Buying a put and selling a put at the same time. And because I expect the market to fall. So this is February 18, right? So maybe this is just before the market top. And at the same time, I saw the market will continue falling. I saw there was no end yet, right? Still falling. So I used the SPY. The SPY is the S&P 500 ETF. You can also buy option on it, right? So I continue buying a backward spread. So these are the ways I saw, hey, market top. Why don't we just make some money off the short term? Because we can this. No one knows where now at this point in time, I also don't know where market bottom is. Right? No one will know one, right? You only can see the price, right? So you see the price, you see where the charts are, and you make a decision as such. But just remember that shorting the market is an advanced skill, right? It's not a skill that every investor will know how to do it. Because remember, stock markets go up in the long term, right? Or you see the trend is up one. So if you short the market, you're going against trend, right? So this is something that you need to remember. It's an advanced skill. Unless at least you know how to use it. I will really advise investors, if you're not experienced, don't short the market because you're going against the trend. right? So in late March, I was showing the market bottom. What did I do? Well, I started to load the shares. This is one of my accounts. I mean, these are some of the shares I hold. You can see these are all leading companies, right? Industry leaders. I don't buy those small caps on this. Is not my style. I like to buy industry leaders. So I started to buy them. Now you can never buy them. Now this is just before the bottom. So I thought I also don't know exactly the bottom is, right? I see roughly that's there, right? So that's the signal is like, then I start loading up. So you need to you the thing is when the signal form, do you dare to buy, right? So you dare to buy. You read all the, if you read the news, you won't buy one. Right, but if you read you have a processors, you have your charts, it tell you, hey, yeah, why not? Let's get in. This is the right time. So, and I always buy in batches and never buy all in one shot because you can never know, right, exactly what they made another bottom, right? You buy in batches so you can average down if necessary. And then I close all my bearish spreads. So because market really bottom already, so no point holding it. I cash out profit from there. So now I want to give you this interesting chart here. Now this is the S&P 500 client positioning chart provided by one broker called IG, right? They do it. You can find it online as well. You can find yourself. Now, very interesting. You see this retail means the average investor, right? Retail investor. We're all retail investors, right? We're retail investors. So just follow my chart here. So this line here is the S&P 500, right? S&P 500. It's until June now. Okay. So and then this line here is the traders who are short selling the S&P 500. Means they expect the index to fall, right? The blue line here is the traders who are long. They are buying the index. They expect index to rise. So this was the COVID period. This is a pre-COVID crash. So you see, when the S&P is rising, what is the percentage of traders? Most of the retail investors are actually bearish, right? So when the S&P is rising and you are bearish, what happens, right? You lose money, isn't it? So the retail investors always get it wrong, right? So just let me show you, for example. And when the market start to fall, what do you see here? You see, suddenly the investors, hey, oh, this is a great time, right? Shouldn't we buy now? Actually, they didn't make a wrong decision. I mean, when market fall, if you don't even know where the bottom is, you cannot read. They might just average down, right? You can always buy because long run. If you're a long run, they always go up in the long run. No, they did. Some of them get it right. They started buying. It's a bit early. I was still shorting, right? Remember, I was still shorting then. It's a bit early. Then they got in. You can see because you see the line go up. This blue color thing is long. All the investors were buying, right? So what happened? Index continued falling. Remember, I was telling that earlier just now. The index took 1 month, destroy everything they gained for 1 year, 2 months, isn't it? 1 month, kill off 40 months of gains. Very scary for any investor. So they got in, but what happened? They realized, hey, market's still falling. Okay. So people started to sell, right? They buy, they thought, hey, it's still a crash, they sell. So they sell at loss, right? And then they continue buying again, right? Continue buy, sell at loss, buy, sell. The CC got higher and higher and higher. See this line here. Buy, still going down. What happened? So here is the bottom. So what happened at the bottom here? You can see here, the red line started to spike up. All the investors who bought here, because they expect the market to come back, right? We're so scared. They sold everything, right? They sold everything. And I don't know how I don't know why. Whenever retail investors sell everything already, right? Market bottoms. This is the funny thing, right? Market bottom. You see the market bottom. This is retail data. I can't go wrong, right? So market bottoms when they had let go of every single thing in their portfolio, and then they realize market bottom. So you can see here, market start to come up, and you look at this line here against this line here, right? This line here was so high, right? All the suddenly market retail investors became bearish. They expect the market to fall further, fall very fast. What happened? S&P rise up very quickly, right? Very, very fast. As the investors get more bearish, S&P continue to rise, right? So what happened when the investors who actually short the market here, they lose money. They lose a lot of money. Right? So I just want to give you an idea is that when retail investors always get things wrong, right? When early before the crash, S&P rising, they were short. At least at the crash, they go and buy, and then they're losing when they go and close the position, right? At the end of the crash, they start to short again, right? And then the index rise very fast, and then they lose money again. So only recently, which is somewhere here, you can see here, did the short sellers start to go down, right? Start to taper off. When the index is already 6% below the high already, right? When you meet a high, then they go and buy, then after they crash again. So you see, we follow I don't know how, I had no idea why, right? Because I assume when they read the news and make investment decisions. So this is what happened, right? If you read the news and make your investment decision, this is exactly what will happen. So never read news, because you will become one of the retail investors inside this chart here. So what's the same this time, right? What's same and different this time? Difference is that the nature of crisis is different, but greed and fear is the same, right? You see the fear index, it's the same. The bulls bear ratio I showed you is the same, right? Put call ratio we saw just now. So it's current sentiment. It gives investors who know how the market works a chance to use the situation and gain advantage to build their wealth very quickly. Okay, I'll give you a quick example here, right? Just to help you in identifying market tops and bottoms. Right. The first, for me, whenever I see something, I always look at charts first, because that's like my routine. Right? I want to see where the market is right now. I'll give you an example. I'll just focus on Nasdaq today, so that we can because we are short of time. So I'll give you an example of how the Nasdaq look like, right, with this thing. Okay. Okay, you can see the Nasdaq. Let me give you an example here. I use the weekly charts. Now I'll go back to the crisis years, which is sometime 07, which I was mentioning right just now. Okay. Okay, the 07 one wasn't so clear for Nasdaq. This is the S&P 500. S&P 500, 07. Okay, so you can see here, right? Now, this was October 07. You can see the chart here, right? 8 October 07. This is a weekly chart, so one bar equal to 1 week. This is what we call a double top. So this thin red line is a 20. This is the 50 SMA, 20 SMA. Now you can see here, suddenly the price made very fast. Right, this was the line here. This was the previous top. When they take out that top very quickly, and then they form a bearish formation. So this is what we call a bearish pin bar, right? You can write it down and you can Google it. You can find. I mean, if another day I'm holding a seminar on a candlestick, I'll tell you more. What this one is a bearish formation, right? Bearish pin bar. Oh, this is a signal. The price went up so fast. Now, whenever you see price let it go up very fast, don't be bullish, because some things are done this way in order for the big investors, right? The market is always run by big investors because they are the one with the money, right? The institutional investors. So they do this, right, so that they can sell high, right? So investors may have bought here, sold here, and then they sell here. They thought they can sell, maybe a market crash coming, but then the big investors come in to create this double top for them to sell. So what happened after this double top? Market started to go down already, right? So that's why I was saying, right, in October 07, this is where the top is. Now the bottom, March 09, same thing here, you can see here. So whenever you see red candles going down very fast, don't be scared, because it means that it may be bottoming soon. So again, this was the first bottom, and then they sell down very quickly, create another bottom here, and then they start to go up. So this is what I call a double bottom. Now you can go and Google and find out what's double bottom. These are important patterns that we take note to identify top and bottoms, so that we know that so that we know where the tops are, bottoms are. Now, did it happen now this is another example which I won't go through, but basically they are all over the chart. So you need to look at the charts, right? Even this year, I saw that double top. I knew that okay, something was wrong. So this was the COVID, right? So you see a market top here. Very interestingly, during this period of time, the coronavirus news is already out already. So people are saying, hey, you see, market is ignoring the coronavirus news, right? So you see, going to make another top. But you see here, very fast, boom, boom. It took out the top here, right? Took out the top here, and then formed a bearish candlestick formation. So you tell me, hey, this is classic. I remember 18 February, I started short. This is classic double top, isn't it? So I knew that, hey, come on, guys, let's not be too euphoric here. I think we're going to see a big crash. How big? I don't know. I probably think it's going to see a big crash, because whenever there's a double top formation, the crash very big one. So you can see market went down. How I wouldn't know it went so far. I no one know. But then it created a buy signal here, right? So this is not a double bottom, but this is one of the formation we create. But so this was the previous bottom. When you see candles come out so far like that, don't be scared, because you know the bottom is coming. So it took out the previous low, and and then they form a bullish candlestick, and you know that okay, you know we are probably at the bottom. So these are some of the various signals that I look at to identify market tops and bottoms, and you can use this example to understand. But of course, if charting is not your forte, you don't want to learn, which I encourage you to learn, then you can use other things. Like I was showing you so things like the VIX, right? The put call ratio, the VIX VIX index, bulls bears indicator, the calculation. So these are some of the other things that you can know to identify tops and bottoms. So at least you know you won't buy at the bottom, you won't buy at the top, you won't sell at the bottom. I'll give you an example here. Now, bulls bear indicator, 25th of June and 3rd July. Why I want to say that? 25th of June, you see market is more bullish, and 3rd July, market is more bearish. Now, when this happened, when markets is less bullish, market went up. Right? In July, if you from this period to this period, you're going to see the charts, right? Market went up. So it's funny, whenever retail investor is more bearish, market goes up. Market needs retail investors to be bearish in order for the market to continue rising. Right? So you can see here, 25th of June, the July. So retail investors, 36% is bullish. 3rd July, this is the weekend, only 28% is bullish. So you can see that the chart here, right? You can see here, right? There's this was falling. Then when investors become more bearish, market went up. Right? Investors who are bullish fell by 20%, market went up. So this is how the market is like, right? So markets need investors to be less bullish so they can continue to go up. So this is so always remember this how things are. So where are the opportunities that you can see now? You can use many different websites or apps to help you do that. But what I look at sectors. Right? You can break out all the sectors here. Where you can see consumer cyclical, financial services, and so on and so forth. So search for the sector first. For example, go technology. Right? You can see this. Then they will help you determine. Okay, these are the industry leaders. Right? So for software, industry leader Microsoft, right? Adobe, Salesforce, so on and so forth. And then for consumer cyclical, retail, Amazon, right? Amazon is not just a retail player, it has a lot of business which I can go through later. Home Depot and so on and so forth. So where do I find this thing? It's actually quite straightforward. Let me give you an example. I use this thing called Guru Focus. I mean, you can use other things. It's a subscription service, but I use them to actually to uncover the industry leaders. Right, you can go here. Right, so industry overview. And then this is where all the sectors are, right? So let's say I want to go technology. Let's click technology here. And I look at the sector overview. Then you can have software, hardware, right? Semicon. So let's say I click software. Okay, then you list out all the industry leaders. So from here you can see that, okay. So this is how I start, right? You got 7,000 stocks in the stock market. Where do you focus? Look at the leaders first, because leaders has the monopoly clout, right? They are the strongest company in the whole industry. Look at them first, and then you can slowly go and find out. Look at their fundamentals, which one is good, which one is not good, right? So but at least you know how to uncover the opportunities. Now, if you want to be an investor who is well diversified, then you should diversify yourself across all the sectors, or rather many of the sectors. And if you are, let's say you want to have a tech bias, right? Then your portfolio you allocate more to tech, but you should never 100% focus on one industry because it's very dangerous, right? It's very concentrated, right? So focus across different sectors. Even in the same sector, you can have the software, you can have the semicon, and you get the hardware, right? So what are the hardware leaders? Let's take a look. Right, Apple, right? Apple hardware leader, very simple. I have Apple in my portfolio. So let's look at consumer cyclical, right? In this sector, you have many different things as well. So let's say you want to do travel and leisure, right? I also have one of them in my portfolio, Booking Holdings, right? So Booking Holdings is very big, just to let everyone know. It's not a small company. So Booking Holdings is industry leader here. You see, look at that. It's bigger than all the other companies here. So you by focusing on the industry leaders, you won't go wrong, lah. I mean, yes, you probably go wrong, but seldom go wrong. Why? Let me give you an idea. If you go to this one, tell you where all the gurus, or rather where all the so-called fund managers and big players are placing their money, right? So if you look at their picks, it will tell you where they actually hold their money. Let's say consensus pick, aggregated portfolio. See this the one. Hot picks. Okay, so now what I do here, these are, let's see, let me wait there. Okay, so if you don't know what to buy, right? So you can go to Guru Focus. You see which are the stocks that's held by most of the gurus. So Wells Fargo, Facebook, Berkshire Hathaway, which is Warren Buffett's company, right? Booking, Amazon, Microsoft, Charles Schwab, Return Health. So these are big companies. So it's held by all these gurus. So if you hold, yeah, maybe I should just filter them a little bit. Okay, sorry. So there, go back to that. So these are the Microsoft held by 57 gurus, right? Google, Facebook, GOG is just different symbol, but the same company, right? Alphabet. AMZN, Baba. So you just follow this, probably won't go wrong. I mean, let's say how many stocks we have here, about 20 plus, right? So you won't go wrong. So just always focus on industry leaders. So you can use many different ways of uncovering opportunities. So, like I said, where to begin? Diversify, always diversify. Right, focus on industry leaders. You can use various tools. Like, for example, Seeking Alpha, you can use that as well. Morningstar, Simply Wall Street, Guru Focus, which I showed just now, Motley Fool, for example, or Investors Business Daily. So these are some of the tools they use for research, right? And learn technical analysis, I always mention to better time your exit and entry. I'll give you an example of Amazon, right? Ticker symbol AMZN on Nasdaq. So Amazon is a big player, right, in the market. You can see here his revenue stream is very diversified. Online takes up 50%, and followed by AWS, right? Amazon Web Services, very big in the market. It's a market leader, 12.48%. Third-party resellers, 20% almost, and then the rest. So it doesn't just sell e-commerce; it has a lot of things. See, it's very well diversified, right? And Amazon is a free cash flow giant. It generates so much free cash flow. As you know, if you do fundamental analysis, right, the stock price is the present value of future cash flow. So it's important, right? The company generates free cash flow, and sales growth is so tremendous. So price earnings may be very high for this company, but if you look at what it's doing, its growth rate is tremendous. And if you're an Amazon investor from the start, right, you have made a lot of money. So I just give an example here. Now, if you invested Amazon at the end of the last crisis, which is March 09, $75.61, right? By this year, June 20, it's really past this already. It's $3,000 plus right now as of now. So it will have been a compounded growth rate, calculate yourself, right? It's 38.86%, right? And if you put in 10K during March 09, you have grown to almost 370,000 today, right? So for in a period of 12 years, 11 years, in fact. So this kind of growth rate you cannot achieve anywhere else, right? You have to find, you only can achieve it in the stock market over the long term, right? So question is, you ask, when do you sell Amazon, right? Imagine you bought it here March 09, and then you see February 11 you sell it because you thought, hey, market made a new high already. I think it's the time before. Then you have missed out on the next 10 years of growth, which you made 153%, but you lost out 3,000% of growth. So Amazon is a company I don't know, I will never sell it, right? It's a tremendous company. I think you will see 10,000, right, in future, and it won't take too long, right? So it's really 3,000 plus right now. So many stocks, so much work now. Investing is maybe very rewarding, but really needs a lot of time. And Amazon, it may be the leader today, but in future, 5 years from now, nobody can predict, right? Nobody will know. So you must always do your homework, always be on top of market development, and diversify, right? So is there an easier way? Now the thing is, there's no easy way, right? But is there an easier way? I probably think you can consider other things like ETF, which is called exchange traded funds, or mutual funds, right? Now, what are the key differences here? Exchange traded funds are more passive, right? They are based on an index. For example, you saw the SPY just now, it's S&P 500 ETF. So it's based on certain index, based on certain sectors, right? It's not managed by a fund manager, so they're more passive. Whereas mutual funds are managed by an active fund manager, they actively pick the stocks that will make money, and then they will sell those that don't make money. So they actively select stocks. They have a team, they have a lot of resources. And they are what we call institutional investors. They are the big boys. So if you buy mutual funds, right, you are on the side of the big boys, instead of you are the retail investor who got killed by the market, right? Like what I saw just now. So if you ask me, you probably want to be on the side of the big boys, because that's where you can know that you are in better hands. If you don't want to do all the homework, right? So better to be with the big boys, because they are the one who help you to grow your money. So benefits is they offer very wide diversification, right? You are not focused on any single one company, right? So any one company that go bust won't hurt you. Right? We have seen recently, right, some companies that go bust like Hertz, Luckin Coffee, Wirecard. So if you are investing in this company one by one, you do face such a risk, right? But if you invest in things like ETF or mutual funds, is very widely diversified. Uh, you have exposure to worldwide markets, not just in US, right? You have Asia, China, wherever the world. So you can grow in many different areas because different markets grow differently. Some markets grow more, so you can get exposure to even more markets is even better. Of course, much less work. In fact, if you have a fund manager picking the stocks for you, don't even do anything, right? You just rely on their expertise. So these are offered by PIAS. So now if in the next webinar, if there's one, I will go into this deep dive here, right, to let you know how these companies are doing and what are the opportunities in these companies that can help you if you are those who are interested in investing in the tech market. So with that, I pass this back to Sibi.
Sorry, I was muted just now. Thank you everyone for participating. If you have any questions, you can type in the chat box. Mr. Jeremiah will address that.
Yeah, just let me just give a quick US equities, maybe from Miss Yo, HS Yo. Will equities revisit the lows of 23rd of March? And I was saying that I really think it's unlikely because markets have been making newer highs and making newer lows. Higher highs and higher lows. If you look at the Nasdaq, is doing so. S&P is not following that yet. So I really don't think they will make a lower low, right? They have made a higher low. So one criteria has passed already. So looking at the way the market is, I don't think you'll make a lower low. Okay, so buying on dips, right? 20 MA, 50 MA is based on weekly charts. If you're investing, I think using weekly charts will give you a much better idea of where the market is because daily charts is more suitable for trading. Yeah.
Are there any more questions? So if there aren't any more questions, before we end this webinar, we would like to hear your feedback. Please fill in the feedback form. Please wait a minute. So that we can send you a copy of the slides after the webinar as well. We apologize for the blurry screen and technical glitches. Additionally, if you are keen to find out more on how to participate and get some profit from the bull run, indicate in the feedback form and we will get in touch with you. You can scan the QR code or you can type in the link. Thank you very much. We'll be ending this in 5 minutes. Oh.
哦，等一下啊。
Hi, we'll be ending this in 1 minute. Please fill in the feedback form. Thank you very much for participating. Thank you everyone for staying to the end. We'll be ending this